Good morning from London. I'm Anna Edwards alongside Kriti Gupta and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. Hostilities between Israel and Iran enter a fourth day, stoking fears of a wider war in the Middle East. President Trump says the two sides may need to, quote, fight it out before a deal can be reached. Oil extends gains, with the market bracing for any disruption in the region that produces about a third of the world's crude. Gold nears a record high, but broader markets show resilience. Plus, President Trump lands in Canada ahead of the G7 Leaders Summit, with tensions in the Middle East and global trade set to dominate.
A flurry of geopolitical headlines around the world that we need to be thinking about. But if you look at futures, you wouldn't necessarily think there was something going on unless you look at the Brent price. That's where the 74 handle of Brent crude is so crucial amid a backdrop of a fairly sanguine move in futures and a fairly sanguine move in the dollar as well. We're going to dive into the details. The countdown to the opening trade starts right now.
Welcome to the programme. A weekend of conflict continues in the Middle East, and the markets once again waking up to react to these developments. But what is standing out, as we said in our headlines, and as we said, as you said there, Kriti, as well, what is standing out that yes, the developments in the Middle East demand our immediate attention. But from a market perspective, yes, oil prices go a little higher, yields a little higher, but things are calmer than Friday.
Yeah, the big question for the market really is, does Iran block the Strait of Hormuz? Does the US get involved? Of course, the second kind of dependent on the first, but analysts saying that the first, pretty unlikely.
Absolutely. And does that even matter in the context of when we're watching the G7, when we're watching central banks around the world today? Plenty going on in the geopolitical space, but of course the Middle East front and center.
Yeah, absolutely. Let's get to the region. Let's get an update. Our colleague Jemana Besetcha is standing by with an update on things that have been developing over the weekend. The conflict between Israel and Iran is now into its fourth day. An Israeli strike in Tehran has killed another key military official, while Iran has fired several waves of drones and missiles over the last 24 hours. Israeli emergency services say 14 people have been killed and 400 injured in the attack. Let us get to Jemana Besetcha, who can bring us up to date with the details. Jemana, good morning.
Yeah, good morning. So it doesn't seem to be like there's going to be a let-up in terms of these attacks and counterattacks between Iran and Israel. We are entering to the fourth day of conflict now, with the attacks on some key Iran military, defense and nuclear sites continuing over the weekend. Those Israeli airstrikes taking out as well some of those senior commanders that we spoke about from the Revolutionary Guard. But then also interesting to note that the IAEA put out their initial assessment of the Isfahan nuclear site, suggesting that some of the damage there was actually quite material, which means that it could set back Iran's nuclear ambitions by a couple of months. Crucial, of course, because this is one of the major objectives that Israel is trying to achieve here in terms of stopping Iran from obtaining the ability to develop a nuclear weapon. In terms of the total death count, though, the Iranian health ministry, these numbers are not updated for this morning, are now saying that the death toll is 224. That includes some of those nuclear scientists and the senior commanders. On the Israeli side, the Iranian attacks also continued. For their part, they've been firing ballistic missiles and drones towards central and northern parts of Israel. Most of those missiles have been intercepted by Israel's very sophisticated air defense systems, but some of them have actually managed to penetrate through the system this morning. We're looking at a lot of wreckage around Tel Aviv, and the latest figures out of Tel Aviv this morning suggest that 5 people were killed in these overnight attacks, bringing the total number close to around 18 people that have been killed since the conflict started on Friday. So no signs whatsoever of a de-escalation. Remember, the 6th round of the US-Iran nuclear talks were supposed to take place in Oman yesterday. Iran pulled out of them. Those talks didn't take place. And the war of rhetoric continues to intensify as well, with the Israeli Prime Minister saying, we are in an existential campaign. We will strike at every site and every target of the Ayatollah regime, and the Supreme Leader himself saying that Israel will pay a heavy price. But I will just say, in the last 15 minutes, some commentary has come through from the Iranian foreign minister suggesting that they would stop their strikes on Israel if Israel backed down. So perhaps there is a softening of a stance somewhat, but at this point, no clear signs of an off-ramp from either side.
Jemana. Thank you very much. Jemana Basecha, Bloomberg's Horizons Middle East and Africa anchor, of course, bringing us up to date on the latest developments in the Middle East between Israel and Iran. So the other dimension to watch here, and something that the market is really closely watching as we continue to focus on all of these developments in the Middle East, is the role that the US is playing here, the things that the US is doing and is not doing, and the risks of the US getting further involved, because that would seem to be something that would represent a step up in risk. And over the weekend, we've heard from President Trump saying that they're not involved in the attacks, but saying it is possible that they could be involved in the future. All things depend on how things develop.
Yeah, I think it's notable that over the weekend, Trump, instead of speaking to other G7 leaders, spoke to Vladimir Putin on Saturday and in talking about Iran, Israel, and talking about Putin potentially as a mediator in this conflict, an idea that Macron, France's president, has really rejected. But yeah, when it comes to whether the US gets involved, as Jemana says, Trump's saying just fight it out for now.
Well, I think it's a crucial relationship that you point out as well, because, of course, we know that Iran and Russia have a very long history of sharing technology, of sharing potentially that nuclear weapon path. I think it's crucial as well, though. You talk about boots on the ground or potential boots on the ground. We're not there yet, but the United States has been active in terms of defending Israel on multiple fronts, given that the Iron Dome hasn't fully functioned as the way it has in the past, which really speaks to the fact that Iran's actual missile barrage this time is far more highly technological, far more intensive than it has been in previous iterations of these as well. But the fact that the United States is already talking about kind of air support as well, actually is very involved in air support. I believe there are jets even from the UK that aren't actively involved, but were given or at least aided and sent to Israel as well. Speaks to the idea that this could very quickly escalate into something that does bring in Western powers.
Yeah, various Western powers very keen to point out the things they are doing, the things they are not. The UK sending jets to protect its own assets, it said, over in that particular region. Let's move to what this is doing in markets, and specifically let's focus on oil first of all, because we've seen one more step up in the oil price and then a bit of a retreat.
Then a little bit of a retreat, but we're still looking at, I mean, I think it was a 77, almost 78 handle we saw on Brent crude in the Asia session this morning. It has dropped now by about $4. That is still massive geopolitical volatility baked into this price as well. And what's interesting is that this is only coming off of news that when we're talking about the actual attacks within Iran, they've only really been a gas field, a natural gas field. So this is on fears of the actual oil fields or the refineries getting hit. We're not there yet, but that's something that the crude price is reflecting.
Yeah, so the two possibilities, the two risks are that Iranian oil export infrastructure is damaged, and secondly, as I say, that the Strait of Hormuz is blocked. That didn't even happen in the Iran-Iraq war, so analysts kind of saying that highly unlikely. Then there's the question of whether you have Saudi Arabia and the UAE pumping for Trump even more in order to try and make up for the shortfall from Iran, and how much actually that can happen. There's speculation that US officials, by the way, are denying that Trump knew that this was going to happen, hence why he put that pressure on OPEC to pump before this attack happened. But can actually they make up for the shortfall? Another question.
Yes, I think those are the things that we're watching very closely. Attacks on Iranian energy export infrastructure, export being the crucial word, and the future of the Straits of Hormuz. But similarly, I've spent the whole weekend reading commentary by oil analysts who point out how difficult it is, how logistically difficult, militarily difficult, how they're politically difficult. What does it mean for Saudi? What does it mean for Qatar? What does it mean for exports from other parts of the region? So very difficult to do that, and actually might be against Iran's own interests to shut the Straits of Hormuz. But we will get some further perspective on the oil markets as we go through the programme, because it's certainly a big focus for us. The broader market, as we said at the top of the programme, Lizzie, the broader market actually, I mean, you wouldn't say it's risk on, but maybe trying to draw a line in the sand. We see US futures pointing higher.
Yeah, we do. We also had that China data out this morning. Retail sales beating, even if industrial production lagged behind. So a bit of confidence in the early days of the trade war with Donald Trump. You've got gold, though, still near a record high as traders flock to that safe haven. And the Treasury moves were interesting, weren't they, on Friday? You've got yields higher across the Treasury curve this morning, again, because of the inflation fears, in case you get that sustained increase in oil prices.
Well, we are kind of exactly where we were 3 days ago on Friday's session, or 2 days ago on Friday's session, where we knew there was geopolitical volatility, we knew that oil prices were spiking, and we knew that Israel at that point had struck Iran. And I think that's crucial, because the trade at that point was futures down, bond yields down, gold higher. And this morning, you're seeing the exact opposite on all of them. And it brings us back to, Lizzie, you were talking about the trade deal, but it brings us right back to the geopolitics as well, because one of the key pieces of the oil analysis I've read over the weekend has been if there is some question of a regime change in Iran, could that actually be a positive for risk markets? Now, that is only one view, I should add, but it is one that's out there in the ether.
Yeah, I mean, history's littered with examples of regime change leading to power vacuums, so you'd wonder whether that really would be. But really interesting, you referenced what happened in the early moments around yields, but I think it's interesting that during Friday, broadly, we saw yields higher. Today, we see yields a little bit higher. Not huge moves, few basis points, but still higher, as if the market is more worried about that inflation concern rather than what this does to growth. And Treasury's not acting as a haven, so that's something we're going to be watching as well. Let us tell you what else is coming up in the programme then. Plenty of voices on the programme to take us through the market dynamics here. Robert Dishner, Neuberger Berman, Senior Portfolio Manager for Multi-Sector Fixed Income and Head of Trading for London. So a great voice to weigh in on what the fixed income markets are making of these latest developments in the Middle East. Madeline Ronner joins us, DWS Global Equities Portfolio Manager. We will see whether the positivity we see in US futures, how long it takes to get to Europe. Marcus Garvey will be with us, Macquarie Head of Commodity Strategy. A whole host of questions to ask about the specifics in Iran, the types of attacks that we're seeing, what is being hit and what that means for the global energy infrastructure, and the role of the US, really important. Leslie Vinjamuri, Chatham House Director, US and the Americas Programme, will be with us.
Absolutely. Plenty to kick off the week with as well today, but also plenty to keep an eye on in the rest of the week. As Lizzie mentioned earlier, the G7 is kicking off in Canada today. We are going to see those world leaders come together. Now, initially, the agenda was supposed to be about trade deals, was supposed to be about unity on that front, or at least perhaps in negotiations. It feels like the events of the last 3 days have completely changed that narrative. So, of course, some headlines to be kept an eye on there as well. But then, of course, tomorrow is the BOJ rate decision. So we're going to have one eye on the Japanese bond market as well. I believe Sherry-Ann, our colleague over in Tokyo, just had a key interview with the finance minister there, talking then about what those inflationary pressures actually look like. And speaking of those inflationary pressures, UK and Euro area CPI due on Wednesday, alongside rate decisions from the Federal Reserve and the Riksbank as well, followed right by, on its heels, by the BOE and Swiss rate decision. On Thursday, by the way, a potential from the Swiss National Bank to actually go to zero for the very first time in quite some time. And, of course, right back to the focus on inflation on Friday when it comes to those Japanese numbers.
Yeah, so we continue to pick up on any inflation dynamics because they're important, maybe too backward-looking, but still really important right now with everything that's happening. I wonder if the only move we get this week is the SNB. And will that be the most interesting thing that happens, though, in central bank land? Because even the holds, the context around the holds, the narrative around violence in the Middle East, the threat of higher oil prices, that could dominate the conversation, even if we don't see moves.
Well, exactly. You could get a hawkish surprise out of the Fed. Of course, we get the dot plot in this meeting, and the Iran-Israel concerns are going to dominate all of these central bank decisions and the commentary around them. When it comes to the Bank of England, of course, it was a three-way split last month when they voted to cut. They've made it clear they want to see a slowdown in wage growth before they cut again. But again, this inflation worry could mean that it's just not the time to cut again.
Absolutely. I think the theme for this week, I imagine we'll have this conversation on Friday, is that every central bank is kind of on a very different rate path. Very dovish on one side when it comes to, say, Switzerland, for example. Very hawkish when it comes to Japan and perhaps even the United States on that front.
Well, here's what else you need to know this morning on your radar. Multiple cities in the US saw protests opposing President Donald Trump's administration as he held a military parade on his 79th birthday. Nationwide demonstrations displayed the banner of No Kings to denounce what they say are Trump's authoritarian tendencies. The protests were largely peaceful but saw sporadic violence, including a shooting in Salt Lake City. In other news, luxury group Kering is set to name Renault's CEO Luca Di Maio as its next CEO. Sources tell Bloomberg the Italian will be appointed to the job in the coming days. Di Maio will be tasked with turning around the struggling Gucci fashion label, which accounts for most of Kering's profits. The shake-up comes at Kering after its shares raised nearly 80% of their value since reaching a record in August 2021. And Leonard Lauder, the oldest son of the founders of Estée Lauder and former CEO of the beauty empire, has died at 92. In almost 40 years running the New York-based company, Lauder saw the launch or acquisition of such brands as Clinique, MAC Cosmetics and Tom Ford Beauty. His extensive philanthropy included founding with his brother the Alzheimer's Drug Discovery Foundation.
Coming up on the program, we'll have the latest from both Israel and Iran as hostilities extend in the Middle East. Plus, of course, oil gaining, but traders bracing for even more. What is the price floor and the price ceiling on this market action? And, of course, if you're wondering where our very own Guy Johnson is, he is in Paris for for the Paris Air Show. He'll be speaking with many high-level guests, including the Airbus CEO Guillaume Faury, bringing that conversation onto this program shortly. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
The Paris Air Show is usually a hub of blockbuster deals, but this year there's a more sombre tone following the fatal crash of Air India's Boeing 787. Guy Johnson's there for us with a guest.
Good morning, Lizzie. Yeah, let's just set the scene. As we start the Paris Air Show this year, as you say, it is likely to be affected by a number of external factors. The most obvious one, of course, is what has just happened in India. That means that the CEO of Boeing is not going to be here. It obviously casts a very long shadow over events at the show. You've also got the conflict in the Middle East as well, and that's going to cast a long shadow as well. Maybe some of the news, some of the announcements that we were expecting coming from the show may not appear, may get pushed a little bit to the right, may be coming a little bit later. So there's a number of factors that are impacting the show that are obvious, but there's a number of factors that are still impacting what is happening within aerospace more broadly that is maybe slightly longer in duration. There's still a supply chain problem. We're still worrying about what is happening with the tariff story. We don't understand yet what the visibility around that all looks like. And there's also the factor of the dollar as well. The depreciating dollar is something you need to bear in mind. When an industry prices most of its products in dollars and you see a significant change, that is a factor. So there's a lot to talk to Guillaume Faury about. He is, of course, the president of GIFAS, the French Aerospace Association. He's hosting this event. He is, of course, as well, the CEO of Airbus. Good morning.
Hi, good morning.
Is it going to be a quiet show? Like, there's so many things going on at the moment. Does that put a little bit of a cloud over what's going to happen here?
I think the accident last week, obviously, was a very tragic event. We're all working hard in this industry for this not to happen. So when it happens, it's a big setback. But yes, we have a slow start in the show, but I think it will be a good show. As you rightly said, plenty of uncertainties and difficulties, but also some mega trends, more and more people traveling, very strong demand for air travel, and therefore a lot of activity for our industry.
You talk about the uncertainty. Thomas, your CFO, was saying the other day, I think it was on Friday, talking about the idea that maybe there isn't the visibility on buybacks right now because of the uncertainty that exists right now within the industry. Like, how much uncertainty is there? How much visibility do you have? How confident are you in the targets you're setting yourself right now?
Well, we have plenty of contradictions to manage. We have a very strong backlog of signed contracts, customers expecting those aircraft to be delivered, so we have pressure on deliveries. We have a challenging situation for supply chain coming out of COVID, now with the uncertainties on trade and also on conflicts around the world. So we're pushing hard to be able to fulfill our obligations toward our customers. They count on us, but it's an uncertain world, so we have also to
is it getting more uncertain or less uncertain?
I think it's a contradiction. It's full of contradictions. Mega trends are there.
Yeah.
Demand for air travel is there. That's a fact. It's growing.
Yep.
So we have to serve that demand. But on the other hand, yes, on the short term, on the supply chain management, on the way conflicts are impacting the supply chain and our ability to do business, it's becoming more challenging. So there's probably more difficulties to do business,
right.
But the reasons, the fundamentals of business are very strong.
What are the challenges right now? What do you not have enough of? We've talked in the past about engines. Do you not have enough of those? Seats, toilets? Where is it right now that you're facing the challenges right now?
I mean, the uncertainties that are weighing on us are trade.
Yep.
Obviously, tariffs. What is the next steps? Yep. What is going to happen with tariffs? Going down, escalating.
What do you think? Is it going down or is it escalating?
We don't know. So we have to make different scenarios.
What do you think is going to happen?
We have to make different scenarios and be resilient to different scenarios.
Okay.
It's not about thinking, it's about preparing, it's about being resilient. That's the world we're living in. Then you have the security conflicts around the world, which are impacting ability to fly over certain zones. That's difficult for airlines. That is impacting the willingness of some areas of the world to travel to other areas of the world. Then you have the US-China tensions, which are not helping. So when it comes to our supply chain, a lot of things have improved, especially compared to last year. We have by far less critical issues, but the remaining ones are big ones. As you know, on the single aisle, we have gliders, so meaning we have airplanes fully ready to be delivered without engines. We have an engine crisis on our single-aisle aircraft, and that's really what we're trying to solve with our friends from CFM.
Boeing has a new head of sales. Okay, his name is Donald Trump. He is the president of the United States. And it seems as if the message coming at the moment is you order a bunch of Boeing airplanes, you are going to get a better trade deal. Where's the muscle in Europe? Where's the political backing? The Prime Minister's going to be here a little bit later on today. You're going to be greeting him. Where's the political muscle that you need to be able to compete with what is happening with Boeing and the president of the United States?
Right, we like the power of our products.
Yep.
At Airbus, we are passionate about techniques, about supporting what our customers need with the right the product, the right customer support as well. And we have also a good sales guy at Airbus, probably less known than Trump from the public, but well known in the industry. So we are trying to promote our products on their own merits.
But do you need political backing? Is that what this is going to come down to? It feels like an increasingly political story, less about product, more about politics.
Yeah, it plays a big role. Politics plays a big role, so we have to be even better. And that's what we're trying to achieve with our products, again, making sure that customers select Airbus planes on the merits of the planes.
As I say, you are the president of GIFAS as well. Let's talk a little bit about kind of what is happening here in Europe. I've talked to you in the past about the idea that we need a kind of Airbus of defence. We need consolidation. We're going to see some consolidation maybe in the space industry. Talk to me, when the Prime Minister comes, when the President comes, when he comes back from the G7, again, what is the message here in terms of what needs to happen in Europe on the defence side? And do you believe that the budgets are there? Like the deficits in Europe, apart from Germany, are enormous right now. Can Europe afford to rearm in the way that it needs to deliver the kind of defence industrial complex that it needs to deliver if it wants to defend itself right now?
I think Europe has understood, and most of the large countries of Europe, that they need to step up in defense, that Europe needs to take care of its own security, and that they will be, in the future, they will get less support from the United States because the US have made clear that Europe has to take care of their own security. And we have security issues at the border of Europe with Ukraine and Russia. So I am convinced that the countries of Europe know that they have to step up. They will put more money. They will spend more money in Europe.
You think the money's there? Are you confident the money's there?
Money will be coming. We see the early signs, but very strong and clear signals that the money will be coming, that the budgets are increasing.
Sure.
Probably not as fast as what is publicly said, but it's going to come. Germany will be very committed. Other countries will be committed. So money will come. There will be more money going to security. The money will be spent in Europe more than in the past. In the past, the majority of the money spent for defense acquisition was spent to non-EU companies, mostly US companies. This will change progressively. And the money will be spent more wisely, meaning with more cooperations, creating scale. And as you know, we at Airbus are experts in creating that scale. We did it in commercial aviation, in helicopters, as well in missiles with our contribution to MBDA. And we are currently working to create scale in satellite manufacturing and services with our competitors, with our friends from Thales and Leonard.
When does that get announced? When are we going to see that deal?
Well, that's something we have already explained. We are moving forward into the steps of discussing with authorities for the antitrust and creating the case together. So it will come later in the year, but that's something we are very focused on, creating scale in space.
Guillaume, it's great to see you. Thank you very much indeed for stopping by to see us. I know you've got a busy show. Many hats are being worn by Guillaume Faury at this air show. Guillaume Faury, the CEO of Airbus and the president of GIFAS, joining us on day one here at the Paris Air Show. Guys in the studio, back to you.
Guy, thank you. Guy Johnson, of course, on the ground at the Paris Air Show. Much more from Guy as we go through the programme. Later, he'll be speaking to the CEO of Archer Aviation. That conversation a little bit later. Oil prices in focus and wider strategy. This is Bloomberg. Welcome back. This is the opening trade. 30 minutes until the start of trading for Monday, the 16th of June. And the futures picture looks more positive than it did around an hour ago. We seem to be increasingly taking our lead from US futures, which have been pointing higher all morning, and the resilience of the Asia session as well. MSCI Asia Pacific up by 0.5%. European stock futures then turning the corner into positive territory as US futures point a little bit higher. Of course, we saw a lot of equity selling on Friday as we saw markets responding to the initial stages, Chrissy, of the violence between Israel and Iran.
Absolutely. As you mentioned, a complete turnaround from Friday's session. You see a similar story in the bond market as well in the States. We're looking at a 10-year of 443 right now, starting to see some slight upward pressure, emphasis on slight when it comes to the European bond market, only higher by about 1 basis point on the German 10-year. We'll see if it starts to shake out closer and closer to the open. Of course, one eye on the commodity space as well. But as we head there, let's talk about some headlines we've gotten crossing the Bloomberg terminal, of course, coming from the Israeli state broadcaster Khan. They're citing an interview with the Israeli National Security Advisor saying that there's no plan right now to target the Iranian regime heads, that they don't need to achieve the Iran goals immediately. So some conversation there, especially as a lot of people are worrying right now in the commodity market, Lizzie, about whether or not a Iranian regime change is on the cards.
Yeah, so we're looking, as you say, at oil prices up again today, this morning. Just looking at Brent up 0.5%, $74 a barrel this morning. But European gas futures up as well, not only on the concerns that you have a blockage of the Strait of Hormuz, but also because of potential disruptions to Norwegian exports because of seasonal maintenance happening there. So European gas already up more than 6% since the launch of the attacks and continuing the march higher this morning, Anna.
OK, so that's what we're seeing in oil prices at this point. Let's bring in a voice to the conversation to widen this for us, to help us understand the impact of these higher energy prices and how we should be thinking about them. Robert Dishner joins us, head of trading for London at Neuberger Berman and a regular on the programme. So, Robert, very nice to see you. So, oil prices higher. That was certainly Friday's experience and to some degree this morning's experience as well. Are you very quickly thinking higher inflation, higher rates? How do you process this?
Sure. I mean, that's going to be the knee-jerk trade of the market, right? And if you look in particular the European gas things too, for what that means for Germany and the Bank of England this week, that can have impacts. But there is the growth impact as well, as you were talking about earlier. And will the market settle in that this is a potential growth negative? I mean, rates are at 4.5%, give or take, right now in the U.S. when they were sort of circa 1% back in 2022 when Russia invaded Ukraine. So it's a little bit of a different calculus on the growth metrics now. If we see a sustained spike in oil prices. Not, the move we've had now really isn't that. Right,
sustained. That's the key factor. We have no idea, do we? We just don't know how long this lasts for. What do we learn from periods of history, Robert? I know as you sat down, you talked about there's a lot of conversation right now about the early 90s, right, for example.
Yeah, a lot of similarities to then. You had a Fed that had cut rates and then was on hold for the latter part of 1989 before then having to cut rates again in 1990 on the Gulf War. You had a commercial property glut at that point in time. You had a global growth slowdown with Japan slowing. The analog would be China here. Now, we don't have an S&L crisis, touch wood, but there are some parallels to that. But again, it really requires that big sustained move in oil prices to probably get that growth thing and tip things into recession.
What sustained level do oil prices need to be at to see an actual sustainable change or shift in the hawkish direction?
Yeah, so that's a tough thing because the Fed will likely look through that type of dynamic, and that's why this week's meeting is so important, right? Do they go down to one cut? Do they add a cut into 2026? That's the debate right now in the market because the Fed, if you remember, the Fed was cutting in 2008 in the context of higher oil, higher inflation expectations, and those things. So the labor market dynamic will be the guiding force for the Fed, probably more so than inflation.
But this is something that has ripple effects for bear with me, for American shale as well. And that's going to hit in face of driving season, in the face of trade negotiations. There's so many different factors. And I'm just curious, at what point do you start to look at the labor data from the South, from the shale patch specifically, to influence actual bond market pricing?
No, that's a great point. And so, what's going on in construction and a lot of those things, because, I remember talking to Richard Fisher years ago. He was the former head of the Dallas Fed. And he was saying your truck driver is your oil worker, is your construction worker.
Yeah.
And so how do these things push and pull, and how does that influence wage inflation? And so you see a lot of that, for example, like when a hurricane would hit New Orleans or those type of things, or Louisiana or Dallas. And so that it's a great point, and an area we'll definitely be focused on.
Robert, do you see the dollar and treasuries regaining a bit of that haven status if this conflict wears on?
You know, that's a great question. You know, even on Friday, the rally in the dollar was tepid. I mean, we barely got to 115 in the euro, right? And so the question is, because there's still a lot of questions around 899 and that legislation which is coming in July. There's
the revenge tax.
Yes. Well, look, other countries do this to the U.S., right? So there's that question. And so the question is really an asset allocation question. Now, I will say that the balance sheet of the United States came out on Thursday, and we didn't see really much evidence of sell America, at least in fixed income, in that data. And if anything, foreigners increased their holdings of treasuries. So we'll see.
Well, I mean, we've got another bond reopening today, $13 billion of 20-year bonds. Not really what we pay much attention to usually, but maybe that, because it's not a benchmark maturity, means it's going to be even harder to absorb.
Yeah, no, the auctions now have become new events for the market, whether that's a Japanese bond auction, right? We got the BOJ tonight, but also the U.S. bond auctions. Are they coming through? Are they tailing? And those, where is there continued demand? And again, especially in the context of a fiscal, we got to get this bill passed by sometime in July. So volatility is probably going to increase between now and mid-July.
Help us link these two dynamics, because before we were talking about conflict in the Middle East, we were talking a lot about the long end of the Treasury curve, the long end of Japanese debt markets as well, and to some degree in Europe too. Is the steepening trade still on if we see these higher oil prices, or you think actually the short end comes higher?
You know, great question. So it's tough right now. The answer is a little bit of both, right? What do we know about the Fed, right? Almost certainly the next Fed chair is going to be dovish, right? Donald Trump wants a more dovish Fed governor, right? And there's an argument that they should be a bit more dovish. And so, you know, but what is that? Does that increase the long end? So is that the steepening trade, or do we see these concerns on inflation where it's just enough, where it's got to keep the Fed hawkish and we need to take out cuts that were priced in? And again, you know, I point to the Bank of England meeting this week where the market repriced cuts last week. And are they going to have to push back against that, given some inflation concerns? And the UK is in a bit of a pickle when it comes to some of those energy prices. So it really is, I think we're going to start seeing a bit more dispersion in rate markets.
But the market's already pricing in 1 to 2 Fed rate cuts by the end of the year. Does it matter who the next Fed chair is, even if a dovish one, if the market's already pricing that in? Yeah,
but the question is what does 2026 look like? Right? And so does the market then price a more aggressive 2026? And then bringing that back, what does that mean for the dollar, right? We haven't seen that safe haven status.
Is that what people are trading on right now?
To a certain extent, right? Because people are saying, because if you look at inflation differentials or if you look at rate differentials, it's clearly in favor of the U.S. I mean, the rate differentials, I think, end of this year between the central bank policy is going to be over 200 basis points. If I go back to my ECFC function on Bloomberg, and if I'm doing that right, but
nicely promoted, Robert.
Yeah. So, but you do have that dynamic, which should be dollar supportive.
All right, Robert Dishner, threading the needle for us in terms of the oil story and the bond market story. We thank you so much. Head of trading there for London over at Neuberger Berman. Let's go right back to the oil story, though. It is our top story of the day. Oil prices rising after Israel and Iran continued attacks on each other, with the market bracing for an escalation that could disrupt supply from the region. Our reporter Anthony DePaolo joins us from the Middle East to walk us through some of these details. Anthony, how concerned should we be about this spike when in just the last couple of hours we've seen a real retracement from the almost $78 a barrel that we saw earlier in the session?
Yeah, good morning, Kriti. For sure, oil is up and people are concerned, but at the level that we're at now at $75 a barrel, this is not oil is going to be cut off or supply interrupted concern. We're definitely not at that level yet. So it looks like we are trading based on a lot of geopolitical concern, because there is, this intensifying Middle East war here between Iran and Israel. And the risk that everyone is looking for is that it does spread wider in the region. And we did see some concerning developments over the weekend when the first energy installations were impacted. We saw some a fire at a refinery in Tehran, which was put out. We saw a fire at 2 gas processing facilities in the south of Iran. that again were put up, but it did temporarily knock off one of the gas production platforms in the Persian Gulf. Iran is the third biggest producer in OPEC. It's got a huge offshore natural gas field. It's called South Pars. They share that with Qatar. The Qatari side is called the North Field. So it is a big energy provider, but the assets that have been hit so far have been mainly domestic. So that Tehran refinery supplies a lot of gasoline demand around the Iranian capital. The natural gas, although Iran has a massive resource base for natural gas, it's mostly used in the country. They have a huge domestic population and huge domestic energy demand, so a lot of that gas goes there. They don't really export gas. They don't have LNG. Sanctions have blocked them from being able to develop any LNG facilities. They do export condensate, which is a very sour kind of light oil that is produced with the natural gas, but most of that goes to China. And the Chinese have been cautious recently because of U.S. sanctions about buying Iranian oil, although they still are the main buyer. So really what we're looking for is signs of any impact on the oil production or the export facilities, which so far we haven't seen. But there is that concern that has driven the oil price higher since hostilities started on Friday. But again, we're not at that level where people are really pricing in any interruption of supplies yet.
Anthony, you would expect if there is a sustained rise in oil prices that President Trump would be on the phone to the likes of Saudi Arabia and the UAE to pump more oil. Do you expect that they would be willing to do that, given the potential blowback from Iran?
Yeah, that's the main question there. That is a very narrow needle to thread that they've got to watch out, because they do want to maintain stability in the market. If there are outages or interruptions, the position of OPEC and the position of OPEC with spare capacity is that they would go in and add supply. That's the whole idea of having the spare capacity. They would add supply to redress any shortfalls. But that political factor comes in if the Saudis, if the Emiratis, those countries that have the most spare capacity, if they're seen benefiting from something that is hurting Iran. Now, Iran, for a long time, its policy has been that if you hit our oil production, we will hit your oil production, or the West's ability, the developed world's ability to get oil. And so that's the big risk. Now, in this framework, though, the Gulf countries have really strengthened ties, particularly with Iran, because they don't want to be in the line of fire, and they want to have a region where there is not this conflict that allows the economies to grow. So really, what's happening already is a bad scenario for them. But then the Gulf countries, Saudi, UAE, Qatar, et cetera, being brought into this, into a widening war would be an even worse scenario. So they are really working and have been working diplomatically to avoid any kind of escalation like that and to improve ties. And so they're counting on those ties to kind of help smooth the conflict here and keep it confined, to Iran and to Israel. So they don't want to see that spread. So that would be a real conundrum if there were some interruptions. If prices are up because of this geopolitical concern, it seems difficult that they would add that much more oil. OPEC is already in an increasing mode because they have added about 400,000 barrels a day a month, reversing those cuts. So they are adding oil anyway.
Anthony, thank you very much. A lot for oil markets to watch. Anthony DePaola, Bloomberg Middle East energy reporter. Thank you so much for joining us. Coming up on the programme, we will pivot to some other corporate news out this morning. Luxury group Kering is set to name Renault CEO Luca De Meo as its next CEO. We will dig into the impact in today's Stocks to Watch. This is Bloomberg.
Welcome back to the opening trade. Just about 13 minutes until we start to see European equity markets open across the continent. But in the meantime, I want to really zoom into our top story this morning, which is going to be those conflicts between Israel and Iran, and specifically what it's doing to oil prices. Because if you had checked oil prices about 7 hours ago, and trust me, I did, you do actually see a almost 78 handle on Brent crude. We've almost seen a $4 decline, almost $4 decline in that intraday price, only higher by 0.3%. But we are still at a 74 handle. Compare that to the prices you're seeing over in the States, and you're seeing about a $1 difference. Now, this is crucial because traditionally when we see that geopolitical risk premium, that spread between NYMEX and Brent is much, much higher. To have it only be at $1 is something to keep an eye on. And this also begs the question of at what level, at what sustained price level do you start to see actually American shale incentivized to produce a little bit more? And that brings me to my next chart in terms of what that implied volatility actually looks like and what this geopolitical risk does in terms of a historical norm. And that's where we are here. You can see the spike in just terms of the last couple of days and pricing in that geopolitical risk. We are now at an implied volatility for Brent crude going back to levels we saw in 2022. Now, this big spike here is the war in Ukraine, the invasion of Ukraine by Russia. And you can see that it has been a fairly choppy session, or choppy chart, I should say, in terms of implied volatility as we start to see that dependence on Russian oil fade from the market. But that is the level of stress these markets are in. And just to show you exactly what that kind of bullish impulse looks like from a broader perspective, this is a chart. It gets a little bit nerdy, but this is the Brent deck spread. Now, this is what this means for a kind of macro audience here. It's basically the premium between the December contract, the upcoming December contract, and the one next to it. When you see a higher premium, which is what we're seeing right now, that green level, it shows you there's a premium to get your hands on oil as quickly as possible. Now, the reason this is so interesting is because until the last couple of days, this was a negative territory. This was in contango territory. Basically, Anna, highlighting the fact that this market was oversupplied. Not anymore. You can see a real panic and a real bullish bias just from the spread.
Yes, absolutely. A lot of different dynamics on the oil story, and we'll continue to put those in focus. Let's do 3 minutes on the market, starting with oil and its impact with our Markets Live executive editor, Mark Cudmore. Mark, what do you take away from the market dynamics and how they've been trading the violence in the Middle East over the last 24 hours or so? Because, yes, we've seen a bit of a pickup in oil prices, but a lot of that was unwound as we've been through the last few hours. And I wonder what that tells us about the market's response function.
Yeah, beyond the humanitarian tragedy and the fact that we've got a war going on, from a market's point of view, this is very much an inflationary impulse rather than a risk-off impulse. That is almost always the case for a Middle East flare-up, but it's happened even quicker than normal this time, which is surprising given the news flow. So beyond markets, it's not really a market story. Beyond oil, it's not really a market story. It doesn't, prevent U.S. corporates still making money. It doesn't stop U.S. consumer spending. It doesn't impact really on the trade story significantly, apart from, again, energy flows. So it is an oil story, and that feeds into higher yields through the inflation impulse. And then that can also then, on a secondary effect, those higher yields, higher inflation might impact stocks, but there's not really a sustained risk-off move. So overall, the event since Friday, this has largely been taken in stride by markets, apart from in oil markets themselves.
But of course, the oil story important for the central banks who have decisions this week, Mark. Which ones, if any, are going to be the most interesting to you?
I think that the Bank of Japan is probably the most interesting, not because they're going to do anything on the rate decision, but because we're expecting to get more clarity about their plans to trim the balance sheet. As we know, the Bank of Japan just has an absolutely ginormous balance sheet, and they've got a problem with long-end yields going higher, and they've got an inflation problem. They have still negative real yields. So they're still providing kind of very easy monetary policy. They need to raise rates, but that's problematic when you have so many bonds, because that keeps on putting those positions more offside. So there's a lot of uncertainty exactly what they'll do in terms of clarifying their plans to trim the balance sheet. But that's the real risk factor for potentially another catalyst for driving long-end yields higher again. After that, I think there might be a little bit of interest around S&P or Bank of England. But I think really most of them should be taken in stride from a pure rates decision point of view.
Well, Mark, you mentioned the S&P there. They're expected, at least from a Bloomberg survey, to cut to zero. What does it tell you that the two central banks that control the two kind of risk currency or risk-off currencies, the Japanese yen and, of course, the Swiss franc, are moving in two opposite directions?
Yeah, I think they've become two very, very different stories. Swiss National Bank has spent years accumulating reserves around the world and are in a very positive position. Japan, they've mainly bought domestic assets. Now, domestic ETFs have done well in terms of the equity market, but the domestic bond positions continue to kind of get more offside. So they've followed very different policies. I think Swiss franc is ultimately more overvalued and more vulnerable on a tactical basis, but longer term it's not vulnerable. Whereas the Japanese yen at some point really could have a currency crisis if the Bank of Japan proceeds with policies that end up monetizing the debt and effectively depreciating the currency.
Looking forward to seeing what the ripple effects of those are. Bloomberg's Market Live executive editor Mark Cudmore joining us this morning. You get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Critty. So Kering is in focus today amid reports that the company is set to announce that the Renault CEO is going to be their new boss. Now, Renault has confirmed that Luca De Meo is standing down from the company. We haven't yet got confirmation from Kering, but it does follow reporting from Bloomberg and others at the weekend. Now, De Meo is a bit of a turnaround specialist. He has helped Renault's share price double in value over the past few years. They did have some issues around some state-backed loans and pandemic-related issues, but he's really turned the company around, and that's acknowledged in a note by Citigroup in this morning's research, saying that this could potentially be positive for Kering, which does, of course, need a bit of a boost given the long-term decline in the share price. But they kind of caution on this and say it's a little bit too early to get excited. But we are seeing Kering called higher and also Renault called lower. Then in M&A, Spectrus getting a rival takeover bid from KKR following a bid from the US private equity rival Advent. We can see that big jump in the share price. Potentially this is a rival bid, so it's going to be a bit of a bidding war for Spectrus, the components maker in the UK. And then also Metro Bank called sharply higher on a report in Sky News that Pollen Street is looking at a takeover bid for the UK lender, which has been a long-term struggler given its problems with debt. We can see that big drop down last year. It's kind of recovered since then. But Metro Bank set to be a big mover in London trading early today.
Joe, thanks very much from our equities team, of course. Joe Easton with the latest on things we should be watching. We will keep an eye on Kering and Renault. Those are the sort of micro stories to watch. But macro picture, of course, things a little more resilient than Friday. This is Bloomberg. Welcome back to the opening trade. A few minutes to go until we get that opening trade here in Europe. This is a casting our minds back exercise to Friday. As ever, sometimes not too useful in terms of where the futures picture goes here in Europe and then where the cash equities picture goes here in Europe. And actually, we saw US equities moving higher and then retreating during Friday's session, so not a huge amount of direction being given to us there. A lot has happened over the weekend, though, Chrissy, and we do need to factor in some of that. But it seems as if the market is concluding that if we haven't seen a direct hit on Iranian export infrastructure and the Straits of Hormuz are still open, then perhaps there is space for risk assets to go a little bit higher, if not to tread water.
Absolutely. And it's interesting that we're seeing that kind of level already show up in the futures picture, in the U.S. futures picture as well, because the outperformer continues to be the DAX. When you look at the futures picture, higher by 0.2%. But Lizzie, I wouldn't call that a major conviction trade, because when you look at the broad indexes, even at the FTSE 100, which has that exposure to the oil majors, only higher by about 0.1%.
Well, let's take a little look under the hood at some of the potential stocks that could be moving at the open then, Chrissy. I've got my eye on Kering. As we say, it's set to name Renault's CEO as its new boss, a turnaround specialist. Can he turn around Gucci? We must also, therefore, watch Renault as well, as it's going to be left with no one at the wheel at a time when the group's just about to announce this new strategic plan and unwind that Nissan alliance a bit more. So Jefferies analysts highlighting those concerns. We watch those two. We also turn our minds to a bit of M&A. Spectrus here in London in focus, given the board's just rejected KKR's preliminary takeover offer. And as Joe highlighted, got to watch Metro Bank after that Sky report of a potential takeover, Anna.
OK, so some really fascinating individual stories, certainly the one around Kering and Renault worth watching at the start of trade. But the bigger picture is, how is the market dealing with all of the risk dynamics that we saw really illustrated over the weekend between Iran and Israel? As that violence continues into a fourth day there, what does the market make of this? We have seen oil prices go higher. They were up by 5% in the earlier Asia session, but since then retreating, now up much less than that. And we do see that there does seem to be some room for risk assets to go higher. The Asian equity session was pretty resilient. And here in Europe, we open up with the Stock 600 almost entirely flat, the FTSE 100 up by just a touch this morning. Taking some time to get going this morning, perhaps. We are perhaps also seeing quite a lot of flow through those big names like Renault and Kering, certainly previously at least heavily weighted, some of those big luxury names in European markets. So we'll keep an eye on those. The IBEX up by 0.3%. We'll dig into some of the detail there. But for the moment then, what we have is a sort of holding picture for European risk assets as we watch Criti US futures go a little bit higher this morning.
Absolutely. But when it comes to your biggest contributors from a sector perspective, of course, no surprise here that oil is going to be right on top. When you're looking at some of these names, Shell, BP, Total, really taking their cue from what we've seen in the macro picture. And I think that's really crucial as well. To the downside, though, some of those traditional defensive names not necessarily leading the market. I think that really tells you what kind of market we're in terms of the index and contributions to the downside. I'm seeing a lot of healthcare that is starting to kind of weigh on this broader benchmark. So that's going to be one series of names that we really keep an eye on. But just the broader commodity complex is going to be a key. When I mentioned some of the oil names, Lizzie, we also have the likes of ArcelorMittal, for example, taking in some of the move to the upside. You have the likes of Glencore, for example, a larger trading house as well. But from a sector perspective, a little bit of a mixed red and green Christmas kind of picture.
Yeah, I just want to take it to the luxury space because, of course, we have had the Kering news, the speculation that it's going to take the Renault CEO as its new boss. Those shares in particular are up 5.8%. We wait for Renault. But if you look across the broader luxury space, you've got the likes of LVMH, Hermes, Burberry, all up in the green this morning, perhaps because of that stronger than expected China data as well. So strength in that particular sector as we await the CAC and the DAX to open, Anna.
Yeah, absolutely. We don't have that. I mean, it's quite usual that we wait a little while for the DAX to open, but usually the CAC 40 is open by now. But we do, of course, have big names. We know that Kering is going higher, Renault in focus as well. So some big names very much in focus when it comes to the European equity markets. But yeah, the CAC and the DAX both not open just yet. The FTSE 100 up by 0.2%. And just as Friday, we see the energy names are the best performing sector. That was Friday's story. But it's interesting that energy names are going higher, but followed by travel and leisure stocks. There's a bit of a rebound in some of those after the selling that we saw on Friday. But it is, I should say also, it's more leisure that's rebounding rather than aviation. So we do see small moves higher in the likes of Deutsche, Lufthansa and Ryanair, but they're more sort of flat to positive rather than stunningly strong.
Yeah, of course, part of the hit to airline on Friday was because you've got airlines avoiding that airspace around Iran, Iraq and Syria. We had the Foreign Office out of the UK over the weekend advising against all travel to Israel for the first time since 2013. But interesting that airline making a bit of a recovery this morning. We'll keep an eye on all the announcements, of course, as well out of the Paris Air Show.
Absolutely. Lots to digest there in terms of the geopolitical tensions and how that all shows up, but also how does it show up in a macro portfolio. Let's bring in Madeline Ronner, the Global Equities Portfolio Manager over at GWS, joining us this morning. Madeline, a pleasure to have you on this program. Thank you so much for joining us. We're trying to work out kind of how much stock we should put in to this oil move, at least from a macro perspective. We saw risk sentiment really selling off on Friday, only to rebound today. Your initial take on how sustained that might be?
So our take generally is that this will be a fade as long as developments stay as they currently are. I mean, you just mentioned it. So we haven't seen any hit on major export facilities of Iran. And as long as it doesn't escalate also to Saudi Arabia and other assets in the area, we don't think there will be much more major impacts. We think the impact on the oil price will also be a fade, as we have seen with prior geopolitical rising tensions. And the same goes basically for equity markets and the impact that we have seen there in terms of risk sentiment. So usually with these kind of events, it takes like 3 weeks until markets get back to their prior high. Let's see what the impact will be this time. Obviously, it's very dynamic. It will depend on if things escalate or not. But as things stand as of now, we think the highest probability of this is still being more of a fade.
So, Madeline, what does that then mean in terms of risk sentiment? Does it really put the focus right back on those trade negotiations that we've been keeping an eye on?
Again, if things don't escalate in the region, we think yes. We think the eyes will be on the G7. If we can get maybe any announcement or developments towards a deal between Japan and the US, I think that will be in focus. We will have the NATO summit as well next week. Obviously, the Fed this week, even though we don't expect a move there so far. But I think that the trade tensions will go relatively back into focus relatively fast if things don't escalate, of course.
Good morning, Madeline. Lizzie here. As we monitor the trade tensions and we watch the hard data, we're looking out for signals of cracks, right? But are you seeing signs in the corporate commentary that actually companies are becoming less confident about cost control or demand resilience?
So I think cost control companies are still relatively confident, everything that I'm hearing so far, especially also pricing. In the majority of, especially the industrial sector, for example, companies are still very confident. Where we have more of an issue is more on the consumer side, so be it consumer staples or consumer discretionary, where we're hearing more and more from management teams that pricing is getting harder to get and the volumes impact are getting harder as well as the consumer is just stressed. So that's a key item to watch. So, and otherwise, but the resilience, otherwise, the companies feel still pretty confident in my view.
And does your confidence in European industrials and defence as well hold if we do find ourselves in a more stagflationary regime? How much more upside is there for those sectors?
Yes, so I wouldn't say that I would be very positive on the industrial sector in general. I think you have to be very selective in the areas that you have exposure to. So one of those would be, for example, as you mentioned, defense. I would still be pretty confident in this, especially, again, as we go into the NATO summit next week. Obviously, these stocks had quite a run, so that can lead to a lot of volatility in the short term. However, I think there is really a massive regime shift in spending to get up European defensiveness, and that will drive earnings really for the next 10 years. So I think there's really a good cycle going on there. Other areas would be, for example, be the AI infrastructure trade, so everything that goes into that area. Another area would be everything that is tied to the German infrastructure stimulus. So you kind of find a lot of those in the industrial sector as well. And I would really hide kind of in these specific areas because I wouldn't expect like big cyclical momentum going. So our GDP forecast basically for Europe this year is 1.1% growth. That's not massive. It's not accelerating massively next year, even though it's accelerating a little bit according to our estimates, but not massively. So I think it's very too early to get into like really short cycle or cyclical names. But really, I would stay selective in these kind of thematic capex-driven exposures.
Madeleine, it's going to be a big week for central banks, of course. We're going to be watching the Fed, the Bank of England, the SNB and others making their rate decisions. Do you think we're going to start thinking about higher for longer rates as a result of higher oil prices? Of course, it will depend how long the military activity is sustained in the Middle East, but would that be your base case assumption?
So our base case assumptions is that we will see like 2 cuts this year, 4 cuts until June 2026, no cut at this meeting. It's basically because I think the Fed will still will want to wait and see which impact is higher, the negative growth impact of the tariffs or the inflationary impact of the tariffs. Regarding to the oil price that you mentioned, of course, that will be, we expect it to be a fade. We don't expect levels to hold this high. So I think the Fed will basically look through that. Again, if things don't escalate, it's a fluid situation, unfortunately. One thing to keep in mind, though, when looking about oil assets, I mean, the OPEC has been rising. Obviously, they supply already. So towards the end of the year, the spare capacity of the OPEC is going to be relatively limited, still there, but limited. So there could be a risk of further oil price shocks in the future as spare capacity goes down. And so if investors want to hedge a little bit against volatility like that, again, not driven by the recent geopolitical issues, but more longer term, I think the energy sector is still a pretty cheap way to do that.
Higher rates recently, Madeleine, have of course been driven by the higher oil prices and inflation expectations. Do you see us returning, though, to the wider picture, the longer-term picture around debt sustainability? That was up to this point a key driver of what we were seeing at the long end of rates. I appreciate your equities focus, but I know that this has been a preoccupation for markets and something that impacts on valuations.
So valuations, in our view, are still relatively high, especially in the US after the rebound. We still think that's a reason to be cautious, especially, as you mentioned, looking at where interest rates are, and that there is relatively little room maybe to cut majorly to have such an impact. That's one of the reasons why we still still favor European equities over US equities at this point. And the fiscal deficit, we still expect that to, I mean, we don't expect major changes to the bill. We expect that to remain over 6% in the US this year. And that's obviously a concern. I think like the longer term of the yield curve has stabilized to some extent. So that's a good sign and stabilizes market and supports markets as well. But it will definitely remain a key item to watch. And as markets hopefully find some comfort in settling there.
Madeline, how much margin pressure should we expect, not only going into the end of 2025, but perhaps into 2026? What changes your view on that?
So honestly, I would be still pretty confident about the margin development. I mean, I've been very surprised at this earnings season how confident a lot of companies were that they would be able to basically have a mixture between price increases and cost actions to offset a lot of the negative effects of the tariffs. I mean, margins are obviously at record highs. We know that. So there is some risk to it. However, you also have like continued implementation of AI and stuff like that that can increase efficiency. And companies still feel pretty confident about that, and I would believe them as of now. So they not seem to be as worried as maybe I would have been at the beginning of this. Obviously, again, if tariff situation escalates, there might be a different picture again. But as things stand now, I would be still pretty confident that margin pressure will be relatively limited in areas that are like mostly impacted. So again, in the consumer space, it would be one of the areas where I would be worried most.
Madeline, thank you. Madeline Ronner, a global equities portfolio manager at DWS, taking on the impact of weekend developments around oil prices and beyond, and the other macro themes that we're dealing with at this point. Let's have a quick look at the core six and see how they are responding to the weekend news developments then. We have a host of sectors in here. Of course, the luxury sector, very fixated on the Kering trade this morning. LVMH, though, is perhaps benefiting from that. So LVMH is up by 1.3% in this morning's trading session. That's by far and away the biggest move that we see on the core six this morning. Joe Easton, no doubt, has others that are attached to the luxury sector in his focus this morning. Joe.
So Kering, really the place to start on the luxury front. So that one getting a big boost. Actually, the best performer in Europe today as the company is set to poach the CEO from Renault, Luca De Meo, coming in. Now, this is taken very negatively by Renault investors and analysts today. I've been reading some research and a lot of them saying that De Meo was set to announce a recharge strategy for Renault in a few months' time. And now this has kind of scuppered the whole outlook for the revamp of the company. So really taken badly. Probably the more surprising move of the two is the big drop in Renault. A massive decline for that stock today. So almost 6% off on that one. A couple of analysts, Kepler Chevrolet, Exane BNP, all very surprised by this news that he's going to be standing down. And that was confirmed yesterday by Renault. We're still waiting for confirmation that he's going to Kering, but we're set to get news on that. And Kering gaining around 8% almost at the moment. So a big move in terms of those stocks. Then in terms of the UK M&A, a couple of them were on our radar, and we have got a decent move in Spectrus. They've got a rival takeover bid coming from KKR. They have rejected it. They are in talks with Advent, the other US private equity firm. So it's another an example of a US firm coming in and taking out a UK company that's set to go through. But KKR kind of giving that rival bidding is pushing the stock higher today. Then we've got Metro Bank, also looked like it was going to be a big mover, so we'll get the price on that one. So up 9%. This is Pollen Street, according to Sky News, said to be looking at a takeover of the UK lender. That one has struggled for a number of years in terms of some of their issues with their loan book and mortgages, that kind of thing. So that one is coming down. Then Entain, all of the sports, obviously, as I said before, I don't have much of a clue about in terms of the American football and your baseball and that kind of thing. But that's where they're doing well in terms of the US. The BetMGM partnership is boosting Entain. The company has that venture with MGM in the US, and that is why they've upgraded their guidance today. So a bit of a boost for the bookmaker stock. And then finally, finishing on a negative tone, Porsche underperform at Bank of America. Now, they are saying that the tariff impact probably isn't going to be that bad, but they actually think Porsche not selling enough of their cars in terms of their actual demand, tariff aside. So that is the reason that Bank of America has cut that on. Only a small decline today, down 0.2%. Porsche slipping a little bit in Germany this morning.
All right, Joe Easton there with some of those early movers. We thank you so much for walking us through those stories. Coming up on the program, we're headed right back to Paris, where our very own Guy Johnson will be speaking with the CEO of Archer Aviation. A conversation with Adam Goldstein next. Stick with us. This is Bloomberg.
Welcome back. This is the opening trade. 18 minutes into our European session, and we see some slight resilience creeping into European equity markets. Then US futures pointing quite a bit higher. E-minis up by 0.5% right now. On our global agenda, then, of course, we're focused on developments in the Middle East. Oil markets front and centre as a result of that. No doubt that will be one of the themes that's being talked about at the Paris Air Show, but there are plenty of other themes besides. Guy Johnson is, of course, there for us. Guy?
Good morning, Anna. Yes, we've got lots to talk about with our next guest. Adam Goldstein is the CEO of Archer. You probably know Archer as an eVTOL, electric vertical takeoff and launch aircraft producer, but it's got actually a fair few other things that are actually relevant to the conversation we're having this morning in terms of the news flow. So let's get into the conversation. Good morning.
Good morning.
So a few days ago, we see an executive order coming through from the White House, from the president, talking about eVTOLs. How big a step forward is it that the president has made this move? How does it affect you? How does it affect the industry? How much more supported do you feel right now?
Well, the technology has become quite mature. It's really been going on for almost 2 decades now through this development cycle. And as we've been working with the regulators, the FAA and the global aviation regulators, it's become quite clear that there is an interest to bringing this technology to market. Yep. And now you're seeing support come down from the White House, where they're saying it's not just about innovating on the hardware side of things. We also need to innovate on the regulatory side of things too, sure. And that is important in bringing new aircraft to market.
What is the biggest challenge right now? Is it the technology? Is it building Midnight, the aircraft that you're trying to produce? Or is it trying to figure out how that's going to fit into a regulatory landscape, congested airspace, all of the other challenges that exist around the business?
Yeah, it's mostly an execution issue at this point. The funding is there, the regulatory frameworks are there, the partners are there, the supply chain is there, the hardware is there. Now we have to put it all together, bring these products to market, and ultimately deliver a great experience to customers. And that's something we still have to prove.
Okay, so look a couple of years forward. We've got the Olympics taking place in the United States. The president is convinced that we should be having your aircraft flying at that event. Is that going to happen? Are we going to have an FAA certified Archer Midnight aircraft flying people, passengers around that by the end of that event?
Well, I sure hope so. The goal is to start the commercial operations actually this year in the UAE. And that'll give us a chance to really get these aircraft out there, show everybody what they can do, really try to, engage the communities, engage the global regulators, and show everybody the benefits you get from electric aviation. These aircraft are super safe. They have a much lower noise profile, and it's really an ability to bring this new category of aircraft to market.
The United States? The UAE is a much lighter regulatory environment than the United States. It is a much less congested space than the United States. Are we going to have it in the United States by the 2028? I'm trying to sort of nail you down and give it a sort of firm idea, because there are those, and there are many of them, that doubt that you can deliver on that kind of time frame.
Oh, I'm very confident that we will have an aircraft certified by the Olympics in 2028 in the US.
In terms of other challenges that are rearing their heads at the moment you're in the innovation phase, you're not in the scale-up phase, you're not building lots and lots of aircraft. Do tariffs matter? Does the availability of rare earths matter? What are the other challenges that are beginning to come in as a result of what is kind of happening at a macro level right now? Are any of those starting to impinge on what you're doing?
Yeah, well, when I started the company, we really set up our operations in the U.S., where our manufacturing takes place in Georgia, our core innovation tech centers are in California, and much of our supply chain is in the U.S. Yeah. And so we're not really impacted by tariffs, from the long-term basis. That being said, there's a whole new industry that's being born, and there's global scale here at play. Yeah. So I do think it will come into play as we look to expand, but it's really almost hard to imagine how big the industry can be, because it's a new product. It's almost like it's day one of the iPhone. It's like, hey, we know this thing can, have music, it can have the internet, but what else can it do? There's so much to come. When you have a new type of aircraft like this that can change the way people live, they can change where people live, where they work. Sure. It's hard to imagine almost the scale of this.
Okay, so let's say the scale is big. You're going to need a lot of rare earths for the magnets, for the motors. You're going to need a lot of parts that are likely to come from a global supply chain. How are you thinking about making sure that you have all those things that you are going to need in order to build the aircraft?
Well, again, there is a very robust supply base in the U.S., and so that's where we started. Yeah. And so even on the rare earth side, there's great companies out there, like MP Materials, for example, that makes parts in the U.S. That you can get access to. And so developing those supply chains are going to be critical to scaling. And over time, we'll look to make sure that there'll be partners and supply chain, partners all over the world.
Let's just talk a little bit about what else you do. You also do drones, like fairly big drones, but you do drones. That feels like where we are right now. That's an area that is really in the moment. Obviously, the conflicts we're seeing around the world are driving drone innovation at a huge rate. You don't have to go through all the safety checks that you have to go through if you're not putting a person on board the aircraft. Is that where the innovation is going to come from in this space right now?
Yeah, so we announced Archer Defense last year, and that was an opportunity for us to talk about a new partnership that we have with Anduril, where we are building a hybrid aircraft that's vertical takeoff and landing, and will also kind of fit into this new, what people are calling, autonomous and attritable category. So think unmanned systems that can be developed at low cost. And I do think you're starting to see that play out in the global defense industry. And so I do think there's an incredibly large opportunity that everybody is now focusing on, which is very important. The technologies that we develop on the defense side will certainly be available to be ported over onto the civil side. And that cycle, that flywheel that we can create, will just rapidly advance the sort of benefits everybody will see on the civil side.
But in the near term, everybody wants drones. Everybody's a bit more cautious about kind of electric vertical takeoff and landing aircraft that are going to get me from here into the center of Paris. But everybody wants drones right now. Is Archer potentially in the near term going to be a defense company, a drone company? Is that really what your focus could be over the next few years?
Yeah, the civil side will certainly be very big and certainly take a long time to scale up.
Yeah.
But in the near term, the defense side could certainly become the biggest part of our business. I do think there is a renewed focus on defense right now and a renewed focus for innovation in the defense industry. And so we have spent a lot of time and effort there, and I do believe it'll be a very substantial part of our business in the near term.
Is that where the conversation is right now? You're here at the air show. I suspect that last time we met at an air show, you were probably talking on the civil side. Is the conversation different here?
It's really both. I mean, we start with kind of the U.S. and the allies, and there's a lot of conversations and there's a lot of education that's happening right now of what's out there, what's possible, what type of systems can be built.
How quickly is that moving?
Oh, it's moving at incredible speeds because everybody wants to understand where this is going and how fast and what the reality of bringing big systems to market. We've seen a lot of stuff with smaller systems, but the question is, how long will it take to bring big systems? So instead of using, big, giant, transport machines like a C-130, what if you built a contested logistics supply chain that was made up entirely of autonomous attritable drones, where you have thousands of aircraft that can be put out into the front lines that all of a sudden there's no human lives being risked to do those kind of missions anymore. I think that is very exciting to people and they want to know about it.
Adam, great to see you. Thanks for stopping by to see us. We greatly appreciate it. Adam Goldstein, the CEO of Archer, joining us here at the Paris Air Show. As he alludes to, a lot of the conversation here and a lot of the aircraft that are increasingly being parked here are drones. That military side of the business increasingly in focus, and certainly a much bigger focus than it's ever been over the last few years here at the Paris Air Show. From Le Bourget, guys, back to you in the studio.
All right, Guy Johnson from Paris, we thank you. We've got some of the airline stocks this morning making a bit of a recovery after their losses on Friday, of course, off the back of the Israel-Iran conflict. The likes of IAG and Lufthansa in the green. Not so for Air France, but oil continuing Friday's moves higher. You have Brent up 0.6%, WTI crude up 0.8%, and that is where we head next. We're going to be discussing how the conflict will affect oil prices with Macquarie's head of commodities strategy. So do stay with us for that conversation. It's coming up next. This is Bloomberg.
This is the opening trade. About 30 minutes into today's session, seeing some green on the screen, but no major buying into today's session. It feels like a cautious tone, even if we are seeing those kind of marginal moves to the upside, Anna.
Yeah, a little bit of positivity, but as you say, maybe that background caution still remains, given all the political developments and geopolitical developments of the weekend in the Middle East. Now, the conflict between Israel and Iran is now into its fourth day. An Israeli strike in Tehran has killed another key military official, while Iran has fired several waves of drones and missiles over the last 24 hours. The Israeli Defense Minister, Israel Katz, has said the military is targeting the regime in Iran as well as the country's nuclear nuclear facilities. Let's get an update on the latest on the ground. Bloomberg's Dan Williams, who's usually in Jerusalem for us, is here in London now and can give us the latest. Dan, we started out with a pretty firm understanding, I suppose, of what Israel was trying to do. It was about tackling Iran's nuclear ambitions. But as I was just mentioning, there's been a suggestion from the defence minister in Israel that now the regime is something that they are targeting. What more can you tell us about the latest developments there?
That's very well observed. The messaging has been getting a bit murky. At the outset, Israel said that this was an 11th hour strike to prevent what it described as a push by the Iranians to finish up critical technology for creating a nuclear weapon. They also said they were trying to reduce, to eliminate the ballistic missile capacity of Iran, ballistic missiles that could carry nukes in the future or in their present form cause a lot of damage, as we've seen to a degree in Israel. Now there's indication they'd be happy to see the regime toppled. Israel's national security advisor was just on the radio, asked about those quotes by the defense minister. He said, listen, we haven't set regime change as an objective, but should it follow as a result of the destabilization of Iran through our strikes, as a result potentially of the fostering of dissent within Iran, Israel would not be unhappy about that.
He's also said that Israel doesn't need the US's involvement to achieve its goals when it comes to Iran. I mean, is that accurate, would you say? Is Netanyahu really just trying to force the US to be drawn in here? And how much support do you think that Netanyahu can expect from Donald Trump?
The formal position is Israel is not forcing the US to do anything. Israel has the capacity to pursue this offensively alone, although the Israelis have received defensive assistance from the Americans, and that's not a secret. It's open. There's been interceptions and also steady supply of munitions, especially interceptor missiles. What's now being said this morning is even with the toughest objectives in Iran, specifically an underground facility in a place called Fordow, buried into a mountain specifically to withstand an attack such as this, Israel's saying it could even manage that. That's a tall order. It's very deep underground. Israel does not have strategic bombers, B-2s, and the like. However, as we've seen elsewhere, for example, in the killing of the Hezbollah leader in September, if you drop bomb after bomb after bomb after bomb in the same location, the same crater, eventually those bombs are going to burrow down and reach the underground facility. So if, presumably, the Israelis achieve full domination of the skies, they could just keep doing this day after day until, as I said, those bombs finally reach the target.
Let's talk a little bit about how this initial strike even began, and that was allegations around the nuclear program, that Iran is getting very close to the 90% enrichment level. Can you just walk us through next steps here, especially given that talks between the United States and Iran have been shelved?
Well, as you noted, the uranium enrichment is at the heart of this dispute. It is a core project for civilian needs. It's also a core project should a country want to have an independent military option. It creates the fuel for bombs. There's a different plutonium track with reactors. That's not relevant here. This is the uranium track. So the core demand by the United States, supported volubly by the Israelis going back years, is an end to uranium enrichment, the dismantling of facilities that could create highly enriched uranium in the future. The Iranians, prior to this flare-up, balked at that. They said it's a red line. They said this is a project that they've fostered for years going back, a matter of national treasure, of national expense, investment, resources, personnel, scientific know-how. The question is whether there's an off-ramp diplomatically for the Iranians to come along and say, this has been painful, we don't want this to go further, and yes, we're now willing to discuss abandoning uranium enrichment.
OK, Dan Williams, we're really lucky to have you around the desk with us this morning. Dan Williams, usually based in Jerusalem, but in London with us this morning, bringing us the latest on the situation between Israel and Iran. And we can now look at the market impact, of course, huge impact for the commodities sector. We can speak to Marcus Garvey, Head of Commodities Strategy over at Macquarie. Really good to have you with us, Marcus. I want to start with the worst case scenario, something that most analysts are saying isn't really likely. Let's say there is a complete disruption to Iranian oil supply and a closure of the Strait of Hormuz. How high does the oil price rise?
Morning. Yeah, I think fair to say that's not a base case, but if you're talking about really extreme scenarios, we've considered a case where even if only very temporarily oil prices could get, for example, above $200 a barrel, if you're just looking at historic relationships of the sensitivity in changing price versus the amount of supply that could be disrupted in that scenario. But I would stress that neither is that, as I say, a base case, nor is that something that inherently would be very sustainable if it were to occur.
So what is your base case at the moment? What scenario do the current moves suggest to you the market thinks is likely?
So our base case is that you're probably going to push a little bit higher than we have already in terms of the amount of risk premium that's being priced in, and that means getting up into the low 80s for Brent. But then we kind of get to a point where the market scenarios become a little bit bifurcated. If we look, say, over the next 2 weeks, do we go into a scenario where you get some form of de-escalation, perhaps with the US getting involved on the diplomatic side, or do you actually find that, for example, Israeli attacks on Iranian energy infrastructure lead us to a route where we do get, rather than just a risk premium, we can put in actual disruptions to oil supply? And if you're in that latter case, then we're probably talking about the price pushing up towards $100 as you put also further risk premium in on greater losses, versus if you go into a de-escalation scenario, while clearly there would still be a significant risk in the market, you could then look at over time that risk premium bleeding out, as we've seen with obviously less dramatic, but still plenty of other geopolitical risk events over the last few years, where you get this initial spike, but then that risk premium decays out as you don't end up suffering a meaningful disruption to actual supply volumes.
Marcus, can you give us your insights on what it is you're watching in terms of the targets that Israel has in Iran? For example, I was reading over the weekend, some people are watching at the Kering Island terminals, which is very much part of the Iranian export infrastructure, through which it sends a lot of its energy products out to China. And that could be something that could be seen as more materially squeezing global supply of energy. What is it that you're watching within Iran?
I think that's an important point that you mentioned about export infrastructure. And there we would distinguish in terms of any Iranian infrastructure that were to be damaged between domestically focused assets, for example, on the refining side, versus, as you mentioned, someone like Kering Island, anything on the export side. If it's domestically focused, it's less escalatory in our view in terms of its market impact, its price, and the potential Iranian reactions to that, versus if it's export focused, then you're stepping into that scenario I'm talking about, where we're already, say, in the low 80s, and you're talking about, well, one, we're going to lose some Iranian barrels from the market, and two, you're increasing the likelihood that Iran does something that takes or increases the risk of other supply coming offline, without even getting to that extreme case of a Straits of Hormuz blockade.
Yes, I mean, thinking about the potential for that a blockade of the Straits of Hormuz, a sort of shutting down by Iran of that strait. Similarly, I mean, Lizzie was implying this, a lot of analysts suggesting this just would be very difficult to do and might not even be desirable for the Iranians. What's going into your thinking about the likelihood there?
I think one very good point that's been made in terms of reasons Iran might not choose to do that, aside from the really bigger picture, is they're also dependent a lot on consumer goods imports, which come through that shipping channel, so it would disrupt their domestic economy. And also, clearly, it's the maximalist position to take. So just thinking about that broader energy picture, if they do that, it's not necessarily their last card, but it's not something that you'd expect them to do in any sort of early phase of tensions. And so I think it's fair to assume that it's not going to happen. But one of the problems you've got in terms of how the market prices it is that you've got this huge asymmetry, as I talked about, in terms of the price risks, that if we go through a period where there's incremental escalation, but then maybe you de-escalate, we're talking about prices coming back down to where they were relatively recently, for example, in the order of $10 to $15 lower over time, versus a case where actually that disruption happens, and then you're talking about prices potentially more than doubling. So that extreme asymmetry, I think, makes it very hard for the market to price. But it's fair to assume that it's not just in terms of the kind of rational iterations that you go through of escalation, that it's something that you get to first. It's near enough the last thing that we would expect to occur.
Marcus, it's Creedy in London. We're just looking at this price action here, 74 handle on Brent crude, a 73 handle on NYMEX. Why is there not a bigger spread between those two contracts?
But that's a fair question. I mean, one of the issues you've got also now in terms of the way that the pricing works is that you also obviously have US barrels that are now deliverable into the Brent market, so that degree of linkage has changed something versus historically. I think something else that's also worth flagging there is if you look at, say, the moves that we had up, for example, on Friday, you saw a greater move in the financial contracts, which also evidently WTI is part, versus some of the physical contracts, including also even, for example, the Dubai market. So I think what that also speaks to is that we are on an underlying basis at the moment, a physical market which has been well supplied and is expected to be materially oversupplied in the second half of the year without any disruptions occurring. And then that also on the financial side, albeit the positioning is nowhere near as sure as it was if we go back to, say, 2 or 3 weeks after Liberation Day, you have still been in a market where financial positioning is net short. And so that as you see those positions get covered, it amplifies the scale of the move that we see in the financial contracts, which WTI obviously is part of it, compared to some of the physical dynamics. And that creates a bit of a distinction in terms of the degree of immediate price response, which isn't just fundamental then, but is really a function of the financial flows and the positioning that predates them.
So that's in the short term. Let's talk about the long term. How long and at what level do oil prices need to be sustained at to incentivize American shale production?
A long way below here, in our view, to be honest. I mean, when we've looked at this, and colleagues in our Houston office have done some very detailed work on it, we think that to get, for example, to a no-growth scenario, you'd need to be in the mid to low 50s, which I think is lower than most people's assumptions, and that really at any price above there, you're talking about varying degrees of growth. And obviously at anything like current prices, then we'd have very, very healthy growth if this was sustained. And I think that distinction in terms of what level you're looking for shale to grow has been a key issue that the market has sort of under, or depending how you look at it, overestimated over the past few years, where the view has been that shale growth would continue to slow. And actually what we've seen is that anything sort of well north of 60 and certainly into the 70s, you're still going to get healthy shale growth. And so at these levels, we don't think there would be any obstacle to that whatsoever in terms of the price incentive.
All right, Marcus Garvey, head of commodity strategy over Macquarie, joining us this morning to talk about the price action we're seeing in the oil space. We thank you so much. Coming up, we're going to broaden out the conversation, talk about the future of the geopolitics and the role of the United States in terms of that escalation in the Middle East. Leslie Vinjamuri from Chatham House joins the program next. Stick with us. This is Bloomberg.
Can you give us a sense of what you're doing to try to de-escalate the situation between Iran and Israel?
Well, I hope there's going to be a deal. I think it's time for a deal, and we'll see what happens. But sometimes they have to fight it out, but we're going to see what happens. I think there's a good chance there'll be a deal.
President Trump signaling a deal could be possible between Iran and Israel, but so far the conflict does not seem to be de-escalating, with fighting now into its fourth day. An Israeli strike in Tehran has killed another key military official, while Iran has fired several waves of drones and missiles over the last 24 hours. Joining us now, Leslie Vinjamuri, director of the US and Americas program at Chatham House. Leslie, one of the things we are watching for, and where you can be really helpful to us this morning, is signs of US involvement. And we know that there is, in the sense of helping Israel to protect itself, to defend itself. There's been a role for the United States there. But what are you watching when it comes to a wider role, and what could trigger that for the United States?
Well, I think one thing that people would like to see is leadership from President Trump that can really help to de-escalate what is potentially which is already very dangerous, obviously, for Israel and for Iran, but which could escalate to include the broader region and to pull the United States in. So people are really looking for U.S. leadership from President Trump to try and persuade both Iran but also Israel that this is a very, very unstable situation. We're now seeing, of course, the question of whether or not there can be more talks, which I think for many people seems very difficult to imagine, but obviously this is essential. You know, Israel has launched these attacks because it has an existential concern about Iran having nuclear weapons. Iran has now made it clear that it won't give up its capacity to enrich uranium, but that it does want to negotiate a deal. And that is really where U.S. President Trump had been hoping to drive policy for quite some time. So I think that is really what we're sort of hoping for. But there is a real risk that this conflict spreads and escalates.
Right. And how would this go down domestically in the United States if the US were to be dragged further in? I mean, I've seen some commentary over the weekend suggesting that those on the MAGA side didn't necessarily vote for entanglement in further foreign conflict.
Yeah, if you go back to President Trump's inaugural speech, January 20th, 2025, he said, I will be the president that is the peacemaker, that ends conflicts, that doesn't take America into new conflicts. He's really wanted to do a deal between Russia and Ukraine, a deal in the Middle East. We sort of know the scorecard. And that broader Middle East piece that he so wanted, Iran and Israel, that relationship is critical to securing that. So this is not what the president wants. It's not what many people in his base want. It's not what he's been communicating to the American people that he was about. And certainly Americans don't want to end up in a direct confrontation with Iran. I think there are undoubtedly a few people in the Republican Party who for a very long time have been saying that we needed to strike Iran in order to prevent it gaining that nuclear capability. But I'd say that they're very much in the minority.
Quite a bit of restraint from a president who campaigned on the assassination of General Soleimani in his first term as well. Talk to us a little bit about who the arbiter of diplomacy here is. If not Donald Trump, maybe not the diplomats in Oman, perhaps Vladimir Putin?
There is a question about that. What role will Russia play? And, of course, you can't really take that in isolation because whatever Russia does when it comes to Iran and Israel, the U.S. is going to be thinking about this in the broader context, as are Europeans. But I think we shouldn't forget, right? The Europeans are sort of waving their hands, saying we'd really like to engage in diplomacy. We would like to use our skills. The Europeans were critical to that first Iran deal. They wanted that deal to stay in place. It became very difficult once President Trump withdrew. But I think they're sort of there waiting to contribute to diplomacy. We have the G-7 taking place. Canada's leader, Mark Carney, is clearly also sort of stepping up and would like to play a vital role when it comes to being a leader, not only on questions of the global economy, but also on these broader negotiations. So I think there are sort of many willing participants, but at the end of the day, the U.S. and President Trump will be absolutely vital.
I think it's crucial that you mentioned that European role in there as well. Because if these strikes do ultimately bring Iran to a kind of more restrained negotiating position and put the U.S. in a better negotiating position on their end, I'm curious what the deal might actually look like. Would it resemble going back to something like the JCPOA?
There is a real concern, I guess a lot of skepticism, that whatever will be achieved as a result of, again, a very dangerous situation. And one that's very costly for consumers, for oil producers, for the stability of the international economy, let alone, of course, the first thing, which is the cost to human life across the Middle East. But the deal that might eventually be achieved is unlikely to be much better. And that's the unfortunate reality. But we are where we are today, and I think right now the goal has got to be to persuade Iran and Israel to lessen their attacks on each other and really to bring Iran to the negotiating table, which, again, it has said it would like to do. It's incredibly weak right now. This isn't really the way to have gotten them. It's not clear that this was necessary. I think this wasn't necessary to get them to the negotiating table. But they have clearly signaled that that's where they would like to be.
But let's say that Iran doesn't come to the negotiating table, and if we think about how else it could retaliate here, how likely do you think it is that it targets US bases in the region, say in Qatar? I mean, can it really handle the blowback from states like Qatar and what it could fund the US to do?
Yeah, I think it would seem like not a rational calculation. And, those who spend their lives studying Iran, many of them will say Iran is a rational actor. Their war is a result not only of intentions, it's a result of mistakes in very difficult situations. So that potential that American assets get directly hit and the energy infrastructure across the Gulf gets hit. All of those are very significant risks And again, why those, war is about diplomacy. By other means, diplomacy is absolutely critical, and making sure that it doesn't escalate to those broader set of interests that you've mentioned is absolutely essential right now.
I mean, you might conclude from all of this that Benjamin Netanyahu had lost faith in Trump's ability to negotiate with Iran when it came to a nuclear deal, hence the strike. What do you think the other Middle Eastern nations are thinking of Trump at the moment? When you look at the likes of Saudi Arabia, these nations that Trump prioritised in his first foreign trip, that tour of the Middle East, do you think they're reconsidering how they deal with the administration going forward?
Well, they're in a difficult spot. Clearly, they don't want to see this conflict escalate. Over the weekend, I was in Prague at the GlobeSec meetings, and we saw the UAE minister saying, we don't want this kind of escalation. Force is not a way to solve the problem of nuclear proliferation in the region. And so really condemning the actions. And wanting to see de-escalation, but ultimately, there aren't a lot of options right now. So there might be people, leaders who are more critical of the U.S. position, but that doesn't mean that they have the ability to walk away. They're just in a very difficult place because, of course, people on the ground, right? Leaders are aware of it, and it's not only, of course, Iran and Israel. It's, as we all know, we have to go back to October 7th and to the situation in Gaza, which is really a very serious constraint on leaders in the Gulf and beyond.
Leslie, no doubt the Middle East news flow is going to dominate what happens at the G7, and lots of European calls for de-escalation seems to be their mantra. But there are other things that the G7 will be looking to talk about, and looking at Trump's entourage, the people he's taken with him, it looks as if trade. Do you have expectations that we'll get news flow surrounding tariffs and trade deals?
I do think the war will dominate this. And I think the other thing to mention is, of course, that we're very close to the NATO summit. So even though it's two different meetings, G7 and the NATO, a lot of overlapping members, and there's a very serious concern on the part of the G7, obviously, for what happens to the U.S. commitment within NATO. I think nobody expects the U.S. to withdraw, but, what's the U.S. commitment in NATO? So those issues of security, they clearly flow right into the question of the G7 agenda. But yes, trade, tariffs. Mark Carney's really seeking to lead right now. So this G7 is very critical, and he's also widening it. He's invited Saudi, who are not coming, but he's invited India, who are, and the UAE. So he's really trying to broaden out that leadership. But those traditional issues of the economy, of trade, of the tariff war, of the U.S.-Mexico-Canada agreement, we're expecting a meeting between the American president. But it's going to be difficult to get away from talking about the war.
Thank you very much. Leslie Benjamin, Director of the US and America's Programme at Chatham House, we thank you. It's going to be a busy week with the G7, Chrissy. A lot of central bank meetings, though, also on the agenda.
Absolutely. It feels like the markets, we might just end the week on Friday where we are at this moment, which is we don't know what's going to come out of it. We actually don't know where these geopolitical tensions are going to take us and whether or not they actually move the markets beyond the oil move that you have seen in today, and I would argue Friday's session as well. Lots to digest in terms of the currency impact, lots to digest in terms of the bond market impact. We'll have it covered for you throughout the week. That does it for the opening trade. The Pulse is up next. This is Bloomberg.